Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about commercial real estate, and this is part of Commercial Real Estate Month. I hope you all are learning a lot from it. Today we're speaking with Joe Iacono. He is the CEO of Crescit Capital Strategies. Before founding Crescit, Joe was a co-founding partner and chief investment officer at a hedge fund. Before that, he had positions at Nomura Securities and JP Morgan Chase and Credit Suisse First Boston, where he co-founded the Principal Transaction Group and closed over $6.5 billion in real estate transactions. Earlier in his career, Joe was with Daiwa Securities, where he helped establish one of the industry's first commercial mortgage loan conduit and securitization programs. He also created Payne Weber Inc.'s first CMBS conduit lending platform. Joe holds an MS in real estate from Columbia and a BA from Rollins College. Joe, welcome to the podcast.
Thank you. Happy to be here.
Let's get started first with overall the CMBS market. From my reading, it's been an awful lot of single borrower deals and generally speaking, pretty low risk ones. But how are you reading it all right now?
Yes, there's been quite a bit of activity in the larger loan securitizations, what we call SASB, single asset, single borrower transactions. And you're right. Generally, those transactions are lower in leverage, stopping out at triple B minus in some cases, but mostly triple B level of risk to bondholders. And they work well for large deals. Investors like them bond side because they're able to get their hands around a single asset pretty easily, determine their view, as opposed to a multi-pool CMBS transaction where they have to really analyze a lot of disparate risk amongst many loans.
Right. So multiple asset pools really haven't been seen for some time, right?
No, the
single
CMBS
borrowers.
the CMBS market is active on the multi-borrower pools. What you're seeing and what a trend that has been going on since the GFC is a lack of desire by the banks to warehouse large pools. So you see a lot of teaming where one dealer or investment bank or bank will amass a few hundred million and team up with another or multiple banks that have also amassed a few hundred million as well, so that they can combine to make one pool, as opposed to one dealer amassing $1 billion of loans, taking the warehouse risk associated with holding those loans for whatever period of time until they amass the volume to do a securitization.
Right. And some of that teaming was also caused by the post-GFC regulation around holding periods and different types of
That's
assets,
correct.
right?
That's correct.
So that was a sea change
Yeah,
in the.
that's right. And also a bit of what's driven it is it's taken dealers longer to amass the pools than it used to. The CMBS business isn't quite as popular as it was pre-GFC for a lot of reasons relating to what CMBS went through and CMBS borrowers went through during GFC. But that's changing a bit right now in the market. The CMBS market's actually doing quite well on the multi-borrower pools. So it's fairly robust.
Yeah. So what other factors? That does sound pretty good. If you only go down to double B, that sounds pretty good. Relatively low leverage sounds pretty good. What else do you think is driving that?
Well, on the multi-pool transactions, what's driving those, and those go all the way down to non-rated, all the way down to non-rated, so single B and lower. And what's really driving that is a lack of available capital from alternative sources. So if you think about the providers of capital, which are typically banks and insurance companies, which probably represent upwards of 75% of all the capital that comes into the space, the banks have been retrenching. If you look at even directionally since the GFC have been retrenching. Just so happens that now it's even more acute given what's happening with their bond portfolios and also commercial real estate in general. And so there's a bit of a logjam, both regulation wise, is hampering their ability to lend more into the space, and B, they have existing portfolios of which assets are not paying off and not freeing up new capital. And then they also have bond portfolios where they're invested in treasuries, which have embedded losses, given where they bought them during COVID. Right. So all of that is creating a situation where banks are just not lending as much. And so if you think about how CMBS was born as a result of the savings and loan crisis, right? They were the primary provider of, call it medium term financing to local entrepreneurs and real estate entrepreneurs around the country. When the savings and loans blew up, there was no capital available for those guys and those types of borrowers. Hence, CMBS became very popular, and that continued for quite a while. Banks started to lend again coming out of after GFC and started eroding a bit more of the CMBS space. And also, CMBS had some reputational issues that they had to contend with coming out of the GFC. But what we're seeing now is as banks are retrenching again, CMBS is becoming more popular.
Okay. So if anyone wants to go down and have a look and you're, let's call it under a certain age, you might want to Google REMIC laws. It's an exceptionally important thing. And that particular epoch in time is not a bad one to think about in terms of what might come next. What are you forecasting? What do you expect to have happen with CMBS over the next 12 months?
I think that if you look at underwriting standards, and there's some with CMBS, it's a trading business for the banks effectively, even though there is risk retention, right, which is different than what we had pre GFC. Um, and so they're obligated to hold components of the structure, that element that represent risk of performance in the loans, or the buyers of the junior components, right, the unrated piece, are required to hold that. So that adds in a bit of an element of accountability, so to speak, from an underwriting perspective. And leverage points, if you look at leverage points in CMBS transactions versus what they were pre GFC, they've come in as well. And that's part of the reason why we saw CMBS volume contract over the years, is because the bank option and the CMBS option started to look very similar.
Right.
And given the reputational issues that it had, CMBS, if you could go bank, you went bank.
Right.
And it was just an easier process. And you're able to call your lender after you've made your loan, which is tough to do in the CMBS space. But again, now we see CMBS coming up, and as a result of the banks not being there. And so people know what they're getting when they apply for a CMBS loan, long-term, locked-in, non-recourse financing. And right now, there's a big demand for it for the reasons I described. I think it'll perform well. I think people are not getting over their skis on underwriting, and I think there's been more discipline from that perspective relative to pre-GFC.
So it sounds like going forward, you expect this to be the situation you just described to be what will probably happen for the next 12 or so months.
Yes, I think so. I don't think this will change until you see, or if you see, and when you see a change in what the other sources of capital banks do within the space. And it doesn't appear to me that's going to change materially for the positive over the next 12 to 18 months.
Right, because a lot of people are waiting and seeing basically everything from regulatory environments to what's going to happen with office. It's a wait and see game.
That's right. And we don't, unless you think rates are going to drop to the floor, those bond portfolios that they're holding are still going to have put a damper on capital for the banks in terms of being able to lend new money, right? Deposits have been challenging, as you know, for banks, and real estate portfolios that they have where they were expecting payoffs, right? Periodic payoffs are not happening because the market's in a stall.
Right. So, so we're going to be here for a while.
Feels that way.
Yeah. Well, so one of the things that has changed a lot for commercial real estate as a whole over the last 2 years, I would say, because of many of the factors you just talked about, is the alternative lending scope. I mean, private equity companies, non-banking financial institutions, et cetera, they have really gotten in place in the market. So do you think that there are, uh, is there any particular risk to the overall market that you can see in that shift in lending, the loans we got, not the loans we wanted? Because the terms and conditions changed a little too.
I think that what's different about the private credit component of the market is you're eating what you kill. So when you make a loan or an investment, you obviously leverage it on your balance sheet, but you're holding a substantial amount of the risk, right? Unlike CMBS, where those loans effectively are probably 95% plus levered in those structures, right? So whereas in the private fund, you're not attaining nearly as much of that leverage. So you're holding a very large chunk. So what that means is it gives you discipline in underwriting and or more discipline, I should say, in underwriting, which hopefully should have, and thus far has had, reasonable outcome in terms of performance, although it's tougher to track, right?
Yes. Yeah. Real tough.
Yeah,
Well, I guess the thing that I've wondered a lot during all of these interviews during our commercial real estate month is kind of simple. Is now a good time to start bargain hunting in some of the subsectors of real estate that have been beaten up?
sure. If you can find the bargains, it's very difficult to acquire assets right now because sellers are the bid offer spread is very wide. So there's decent amount of capital that's available or on the sidelines to acquire assets. Would love to acquire assets at under today's metrics, but sellers won't sell based upon those metrics thus far. Yes, if you can buy at metrics approaching what you think they should be relative to where rates are today and whatever the other dynamics in your particular marketplace, then yeah, absolutely. Multifamily is probably a great place. There's probably some opportunity in office for sure. And if you can buy, if your expectation is that rates are going to come down and you can buy based upon today's rates, right, on a cap rate that's reflective of that, then that's probably a good trade. The issue is that it's been incredibly difficult to find opportunities that match those the current metrics because sellers, unless you have to sell, are expecting that rates will come down and that things in the market will free up, and meaning cap rates will then, on paper or in reality, will contract. And so, why would you sell unless you have to? So from time to time, there are people and assets that have to be sold for whatever the reasons. And so opportunity could present it and does present itself that way. But overall, the market's kind of in a stall.
Mhm. Well, one of the things that I wonder about what the trigger points with that might be. I mean, one of the things that is a little bit difficult to me to understand is how many properties out there across the entire spectrum of commercial real estate are holding on to a fiscal structure with that is based on on an interest rate that will not be back forever or long enough that people over a certain age don't care. So, like, is that sounds like a lot? Is it a lot?
Well, it's interesting. So, by some accounts and some studies, as much as 75% of I think it's $1 trillion of debt, CRE debt that's supposed to mature between in the next 2 years, as much as 75% can't be refinanced at the current level of debt, at least by today's metrics. So, and what we said, so there's a lot of folks that that are potentially stuck in a situation where they have they're underwater effectively on their assets. And so your question is, well, how long do you stay recognizing that you're underwater? And the answer is as long as you can, because hope springs eternal.
Right.
And why kill yourself today if you don't have to? Now, what we see is with institutional owners, not all, but many institutional owners, as you've seen with some of the headlines on office in particular, institutional owners are less passionate about the situation and they tend to recognize and move on the losses if they need to. And there's also an issue of just what's the opportunity cost, right? So why hang on to something if you can repatriate some of your capital and reinvest it in a market that has what you perceive to be better returns?
Wait, but the traditional investors in real estate come from a very, very different range of terms, right? The life companies, exceptionally long. Banks, shorter. so, so I wonder how that's going to work into. I have seen some of those surveys that say 75% of the assets need to be refinanced in the next 2 years. Like, I used to write surveys. I know what sell surveys.
Yeah, right.
It seemed a little high. I mean, do you think 75 is feasible?
It feels that 75, the study that I saw was that as much as 75%, and I've seen a few studies, and this is the highest one, as much as 75% of the trillion that's maturing cannot refi at existing debt. Now, that doesn't mean they cannot refi,
Right,
right?
right,
That just means that you can't refi at the present level of debt. Now, 75% does sound high to me, but only time will tell.
right, right. Well, we shall see. Great. So, is there any other thing that you think is exceptionally interesting that you've been talking to people right now that is a risk to the structured portion of the market, the CMBS portion of the market now? Is there any other things that the people who are listening to this should think about on behalf of their clients?
CMBS serves its purpose. It's a cumbersome process to go through, unpredictable in many cases, just because of the nature of how those deals get done, right? Generally, subordinate buyers are leading the charge in terms of what will and will not make it into a pool. And generally, those subordinate buyers are not brought in until later on as the pool is formulating. And so there is risk, that and borrowers sometimes experience that their transaction that they thought they were getting will look different when and it's time to close. And that's just because of the nature of how the business works. So, but when capital's not available from other sources, this is a viable place for non-recourse term financing.
Right.
Right.
Yeah. It's not the one we wanted. It's the one we got.
Exactly. And so, it's got its place in the marketplace, and I think it will continue to do so. I think you'll see less. We have, like you said at the beginning of the podcast, we've seen a lot of the SASB deals or the large single borrower deals happen. I think you'll see less of those. It's just many more to go.
Right.
At least right now. But the CMBS business is robust right now for the reasons described.
Great. Well, Joe, thank you for this great update on the CMBS market, and thank you for being on the podcast.
You're welcome. Pleasure.
And thank you all for listening. As I said earlier, I hope you all are learning a lot from Commercial Real Estate Week, and we will see you next time. Until then, I'm Rob Rowan, and this has been Compound Insights.